Hey gang, Spike here, and welcome to our first episode of Forex strategy results for 2011. And many of you who follow this experiment that we're doing probably haven't seen a posting for the last 2 weeks, and that's because I generally don't like to trade my breakout strategy during holidays because of low market volatility, and we've just worked through Christmas and New Year's, so I don't have a update for the year. But what I do want to do is spend a little bit of time in this episode talking about our strategy and our goals for 2011. So first, let's start out with our goals for 2011. And as you know, our goal is to take our small trading account and turn it into $2,000 per week cash flow. And in order to do that, we have to start out with some kind of a weekly target. And so my goal for 2011 is to generate an average weekly profit of 4% of my account. So when our account is at $5,000, my profit goal would be $200. When we go up to $10,000, then my goal would be $400 for the week. So the goal is 4% increase on the account each week. Now, I also have a goal to make sure that I risk no more than 2% of my account on any given trade. I have a goal to enter at least one trade per week. And the reason I have this goal here is to make sure that I tend to stay active as a trader. Sometimes I get deep into analysis and strategy analysis and EA development, and I don't trade. And if you don't trade, you're not going to make money. So one of my goals for 2011 is to make sure I enter at least one trade per week. And number four, I want to make sure I stick with my strategy throughout the week. So once I turn a strategy on, or once I decide to use a strategy, I want to make sure I stick with it throughout the entire week. And last but not least, if I'm going to change my strategy or reevaluate, I want to do those at the end of the week. And it's because of number two, because we are risking no more than 2% of our account on any given trade, that allows us to do things like sticking with the strategy throughout the week or not making any changes till the end of the week, because even if we have a string of losses, even if we have a drawdown, we still won't lose more than 2% on any given trade. So on our $5,000 account, 2% of that would be $100. We should not be risking more than $100 per trade. So that helps us to survive a string of losses with a strategy. Now, let's talk about the strategy that I'm going to use for 2011. Number one, I want to make sure that I identify the weekly open. And once I identify the weekly open, my entry for a long position will be 20 pips above the weekly open, and a short position I would enter at 20 pips below the weekly open. So a breakout above or below 20 pips above or below the weekly open would get me into a trade. I'm going to set my stop at the open price for the week. So basically I'm risking 20 pips per trade. Number three, I am going to set my profit target at the trade entry and then plus or minus the 4-week average true range divided by 3. So in other words, 33% of the average true range for a 4-week or an ATR over 4 weeks. And I'll explain more about that in a moment. But again, I'm using very, very, very simple rules because my goal is just to make a profit and get out of the market. I don't want to overcomplicate it. And number four, I want to make sure that my share size is based on my 2% loss rule. So in other words, if I'm risking 2% of my account on any given trade, and I know that I'm risking 20 pips between my entry price and my stop, then I have to make sure that if I lose 20 pips, I don't lose more than $100. Okay, so I have to adjust the share size to make sure that that is true on every given trade. So if we start out with the account size of $5,000 and we are going to risk 2% on any given trade, that would equal $100 we are going to risk. We already said that our pip risk is going to be 20 pips. So what we do is we divide $100 by 20 pips. And in this case, I am trading mini lots on the euro dollar. And each mini lot, each pip on a mini lot is worth $1. Okay, so on a 20 pip risk with a $100 risk, I know that I can only trade 5 mini lots per trade while my account is at $5,000, while I am trading the 2% rule, and while my pips per trade risk is 20. So when I'm trading more complex strategies, I actually, um, I change the share size based on this exact same rule and this exact same principle. So I never, ever, even if I increase the number of pips I risk per trade, then my dollars risk is still 2% of my account. So if I decided to risk more pips and still risk no more than $100, then I would have to reduce the share size. Okay, or vice versa. Let's say I decided to risk 10 pips per trade, but I'm only risking 2% of my account, then I would be trading a share size of 10 mini lots. Okay, so that's always changing, but again, it's there to make sure that we don't risk more than 2% of our account on any given trade. That helps us survive a string of losses. Now let's take a look at the strategy we're going to use. The yellow line indicates the open for the week. Okay, this blue line indicates where the week started, and I'm just trying to. So if we look right here, this is where the week started at 131.14, which means that the green line would indicate where we're going to get into a long trade. Red line would indicate where we would go short. So the week starts here, price comes down, hits our trigger for a short trade, and our stop then becomes the yellow line, or the open price for the week. So trade's moving in our favor, it reverses, comes back up, and we get stopped out. Okay, no big deal. That's why we play stops. Okay, so we lost on the first trade. Now price comes up, hits the green line, which is 20 pips above the open price for the week, and triggers us into a long trade. Price continues to move in our direction, retraces, comes back up, retraces, tries to come up again. It looks like it's actually weakening, right? But we don't, with this strategy, we're not making predictions. We're just following what the market does, and we still haven't been stopped out at this point. So we retrace again. Normally, if I was trying to make a prediction, I would think right here we're going to continue on down because we've had a series of lower highs and lower lows, lower high, and then here, not really a lower low, but close. But what happens is we come back up, and this time we break out, and we come all the way up to 132.34.6, which is 100 pips higher than our entry price. And again, we got the 100 by taking the average true range for the last 4 weeks, which in this case was 300 pips, dividing it by 3, which gives me 100 pip profit target. Okay, that allows me to trade within the average true range for the week and still hit my goals. So let's review this again. We take the open of the week and we identify it as open price for the week. When we move 20 pips away to the downside, we entered a short trade, and when we came back to the open price for the week, we got stopped out. Then when we went 20 pips above the open price for the week, we entered into a long trade, and we stayed with that long trade until we hit our 100 pip profit target, and we were done for the week with one winner where we lost 2% of our account, and then we had a winner where we gained 10% on our account, giving us 8% gain for the week and putting us above our 4% weekly target. If you have questions or comments about the strategy, just go to forexstrategyresults.com and post a question or comment. Market's going to open soon. I am going to turn on my EA, and I will give you an update at the end of the week. Until then, safe trading, everyone.